So let's look at the charts and data for 2020, the second quarter of 2021. First thing we always like to look at are the headlines, some of the headlines that kind of piqued our interest, if you will. The first one is Goldman Sachs, which is the perennial New York investment bank, really starting to look at moving towards or building new campuses outside of the tri-state area and picking Texas, a low-tax state, as a destination. We talked about the crypto peak, if you will, last March. Now there's crypto collapse, lumber prices. Again, we talked about last quarter how they basically peaked at the end of the first quarter, and here we are at the end of the second quarter with a pretty substantial give back in terms of prices. Labor shortages, we'll continue to harp on that. That continues to be a theme that comes back. And the shortages, whether it's demographic, people simply leaving or retiring out of the labor force, or is it a mismatch between skills required and skills provided? So it's really a much broader social question. Container shipping, we're going to talk about as well, is the infamous or famous supply chain and how there's a bit of a mismatch in terms of the traffic patterns, and rising rents. Again, conversation around asset owners versus renters. Let's start off with the population vaccination. Again, not a public health statement. It's just we have to agree that this is a pretty important component of people moving around and milling about. So in Canada, we're certainly one of the leading countries with 68% as of July 1st, 2021, of people at least receiving one dose. And so we're UK and Canada are one of the countries that are certainly, UK has opened up more, but Canada, certainly parts of the country are still quite locked down, even though we're leading in terms of first dose distribution. And comparing other open countries like the US, which are further behind on the vaccination front. One of the measures that we show you once in a while is trying to understand what's going on from a mobility perspective. If we're looking at travel, why do we care about travel so much? Well, it's a pretty good window or indicator in terms of consumption around when people travel. They tend to spend more in restaurants. They tend to spend more on consumer goods, and they also has an impact on commodity prices, namely oil. So here we see the drop in travel in the U.S., and this is the TSA checkpoint. So these are the good people that make us walk through the metal detectors in the U.S. So really, we're back to, at the end of June, we're back to over 2 million travelers, which is basically back to pre-COVID levels. And remember, that does not include the business travelers, which are a significant portion of the traveling traffic, if you will. If we look at crude oil prices, what we're seeing here obviously are prices that are spiking nearly $80. What's interesting here is that the oil stocks, whether in Canada, the US, or in Europe, certainly haven't moved up in lockstep with the underlying crude oil price. If we move to inflation rates, these are the published inflation numbers from the G7 over the past 12 months. They're not as high as you'd think if you stop and think about we're coming out of a lockdown situation, and these numbers include the reopening trades, if you will. So from a policy perspective, the central banks are looking at these numbers and are not too worried about it. If you're a consumer and you've gone to the grocery store or your local lumber yard, those numbers look a little light. Moving on to light numbers, or not the matchup between what you're seeing in the published inflation numbers and what we see here are the different commodities. Lumber, oil, corn, these are basically the inputs that go into our everyday life. These prices over the past year are up substantially. It's important to remember, though, that those prices were down substantially, especially if we look at oil. It was down basically, well, it traded for a few days in negative territory, but really it was down to $10, $15 a barrel. So we're up substantially since then, and it's the same for a lot of commodities as the global economy shut down for the better part of, let's call it 6 weeks. at the end of the first quarter and to the second quarter of last year. If we look at average gasoline prices, so again, we're going one up in terms of levels closer to the consumer. We're seeing that the average gas price in the U.S. is $3.40. Why does that matter? One, it has an impact on consumer prices. It has an impact on mobility. And finally, it has an impact on the broccoli that you buy that comes from California. Everything is shipped by truck. And so that has certainly an impact in terms of the prices that we will pay for our everyday goods. If we look at rents, and here we're really specifically looking at rents from a housing perspective. What's interesting to see here is the work from home has really impacted. Many people are leaving the urban areas, and I'll show you another chart a little later around that. And some of the hottest markets from a rental perspective are places like Boise, Idaho. Two things, Idaho is known for potatoes, powder skiing, not really rent increases. Spokane, Washington, Glendale, Arizona. These are not exactly hubs from a dwelling perspective. I mean, in Idaho, there's 2 million people and there's like 120,000 elk. So it's not exactly a mecca or a destination for people to move to. But really, this is more of an explanation, if you will, or an illustration of the supply and demand imbalances. You don't need a lot of new people coming into Boise, Idaho to make the rents fly from a price perspective. Again, we're looking at Case-Shiller home prices. We all know the numbers. Many of us own a home. We all know that the prices are up 15%. We have to go back to basically the beginning of the end of the housing crisis that really began in 07, 08, but prices really peaked in 05 from an appreciation perspective. This is another type of heat map. These are, again, we're looking at the Case-Shiller Home Price Index. What's interesting, or what I want to highlight here, is there are places where the best performing markets, I should say, are really on the coast or in the Sun Belt. So Phoenix, San Diego, Seattle, Boston, and the sort of worst performing markets are in the Midwest. So Chicago, Minneapolis, Cleveland, Detroit. So clearly people are moving outside of out of the Midwest and going to either sunnier destinations or out to the coasts. Metro housing. So again, what we're trying to illustrate here is the Fed inflation target is 2%, but then you look at housing prices changes and they're, 5 times what the inflation rate is. In Phoenix, it was 11 times. So clearly there's a mismatch. And housing obviously can come back to the more 2 to 3% expected rate of return on housing. But what's important to see is if someone is buying a house or bought a house in 2021, that's going to have an impact, and they're house rich or house poor in the sense that they won't have a lot of discretionary income for other goods or services. Here's a chart for the metro housing in terms of levels of rent. This is the chart I was referring to a little earlier. So you can see that rent prices are down 10% in the tri-state area and in Washington, D.C., as well as Silicon Valley in northern Florida. But in northern California, but you've got Southern California and Florida and Texas as being some of the hottest markets. This is probably the most important chart that we're going to present to you this quarter, and it's the change between the yellow line is the participation rate. So we're seeing a significant drop in participation rate. We've really never seen that in context or at the same time as job openings being basically off the charts in terms of high. So we had the jolt down and jolt up in terms of job openings. It's entirely normal, but really we're back to some significant requirement or job openings, which largely can be explained by a reduced or lower labor force participation rate. So is this a job mismatch between the skills required by the economy and the labor pool and their skill sets? And because there's a mismatch, they simply leave the labor pool? Or is it just demographically? It can be explained demographically. More older people simply retiring as the economy slows down, and they don't bother to come back into active employment as the economy reopens. We talked about last quarter about the money supply and how it had peaked. We wanted to show the same chart, but really we're seeing the money supply come back. So that was the statement we made last quarter, whereas 21% of all outstanding US dollars were printed in 2020. We can see that the central banks are taking money out of the economic system, which makes sense when you see the previous chart with labor being in short supply. So clearly, the conclusion here is the continued economic growth is not hinged upon liquidity. It's going to be hinged upon the labor pool and the ability to find the right labor at the right price for the goods makers and the service providers. We looked at Bitcoin last quarter, the pretty significant give back where it's down roughly, call it 45%. This time last year we talked about shipping. So this was a shipping activity last July. This is a shipping activity in 2021. So the problem with shipping is twofold. One, it's like a big chain. So if the ships aren't moving around in 2020 between the people that need or building things and the people that are buying these goods, there's going to be an air pocket in terms of the containers being used. And that's really what we're seeing here. You can see that the ships are back on being busy, and that's kind of a typical picture of a normally functioning economy. But then you look at shipping rates, and I would draw your attention to certain routes. So Shanghai to New York versus New York to Shanghai. I'm sorry, you don't have New York to Shanghai, but let's say LA to Shanghai is quite cheap, and then the same route going the other way back to the US is basically 10 times the price. So the point here is there's demand for shipping containers coming out of Asia, but there's not a lot of demand for shipping containers going back to Asia. So that's something to watch, and you can tell simply by the price. So here's below, we have the share price of Molen Maersk. It's a Dutch outfit, and you can see the containers, whether in Montreal or you can basically see them on trains as well. And you can see the stock price basically was dead money. It's been dead money for a long time, kind of in this trading channel between $12 and call it $6. Hit $4 during the global shutdown, and it's now $14. You can see the stock price more or less follows this container price as well. So you can see the container price, there's some volatility to it, but they kind of stay in this channel of between 2,000 and 4,000. So clearly we're well past that. It looks to me anyway a lot like the lumber price that we saw last quarter. Commodities, our usual three charts. We know the stories. Oil price up 25% this quarter. Copper price kind of up 8% for the quarter, but stuck in this channel. And lumber, as I said, really back from well north of $1,600 a board foot down to under $800. So significant move up. Headlines aren't talking about it, but we're back to the prices that we saw before this summer spike. Treasury yields, again, another type of commodity, the cost of money. What we've watched right up until the end of the first quarter is a significant rise in interest rates. And now we're seeing this interest rate sort of dive or come back to a channel from the 1.75 numbers down to the 1.4 to 1.65 number. So is that a normal give back, or is that the start of a new trend? The lower interest rates certainly explain, or partly explain, the higher or the great performance brought in by technology stocks, because technology stocks always have a favorable response to lower interest rates. In Canada, very much the same story in terms of interest rates. We had a spike in interest rates going into the end of March, and then we've sort of been in this channel ever since. If we're looking at the indices, our usual charts where we're looking at value stocks versus growth stocks. Value is still up slightly, but we're kind of stuck in a channel, so there's a battle that's going on. If we look at the broad indices, the RSP versus the market cap indices, which are weighted according to the value, the stock market value of the components of the S&P 500, we're measuring how broadly diversified the returns are. So what we want to see is there's a slight performance difference between the broadly diversified RSP and the market cap weighted, but it's not nearly as high as what it was this time last year. It's kind of a reverse image of what we saw at the beginning of the month, if you will, of the quarter. The S&P 500, that's our usual chart. We like to show it up. So clearly, some investors are worried about this because they see this large move up and worry about a give back. I think that's a fair concern. While others will see just a positive move past the last resistance point, which was a 34.50, say. And so we sort of had pre-COVID, we're past the high. So it remains to be seen. Probably both camps will be right in the sense that we're probably going to go into a give back. But the positive note of this is that the previous peak, or what acted as previous resistance, often will act as support. On the TSX, it's very much the same story. We have a pretty significant move up from the COVID lows, and we've broken through previous resistance of the TSX. We're at an all-time high over 20,000. Previous resistance being 18,000. So again, we're looking at tech versus non-tech. So the non-tech numbers are up. The Nasdaq's up 7.6% for the quarter, while the non-tech, or the Dow, is up 4%. So it ebbs and flows. It's normal to see some pricing discrepancy, but again, it's not as marked or as different as it was at this time last year. If we looked at this chart quickly, and we're going to review it quickly in the here, but basically, technology is leading the way, and in Canada, outside of Shopify, it's simply banks, utilities, and oil, the major oil producers. If we're looking at flows, this quarter is not a whole lot to say about this chart. There's certainly more money coming into the flows, so we're looking at dollars in for the year to date, up 4%, and for the year, past 12 months, up 8%. And it's the same story in Canada, where we're seeing some significant inflows in terms of dollars in. The distribution of it is pretty much all over the place. I mean, there's no real significant losers or sectors that are seeing significant drawdowns. So again, for this quarter, not a whole lot to say about this chart. Same could be said for bonds. Not a whole lot to say here. We talked about, at the top of the video, we talked about how the curve is flattening a little bit. So the longer rates are coming down, and the rates are on the shorter end are coming up a little bit. But again, that's a normal sort of noise in Canada, and it's the same story in the US, where you're seeing a little bit of a curve flattening, but nothing too dramatic at the moment. If we're looking at the stars and dogs in Canada, what's interesting, or what I want to point out, is some of the best performing stocks in the past quarter or year, over the past 12 months, are now making the list of the worst performers. So we have a copper miner, some gold miners, Ballard Power, which was a tech darling in Canada, and the cannabis stock and Canopy Growth. Over on the winners right now, we're seeing sort of, again, a mixed bag. So that's healthy to see. You want to see sort of a diversified list of best performing stocks. In the US, the names themselves in terms of top performers are somewhat diversified, I would say. You've got, provider of pool products, a software provider, chip maker. So it's really broad. In terms of the worst performing, it's fairly broad as well. So that is a healthy thing to see. So what's our conclusion? Well, is inflation transitory? Remains to be seen. Right now, there's no evidence that it is not. The K recovery is certainly still in play. Again, that's normal. especially since we have seen this asset recovery play, thanks to central banks getting involved. So really the question is around government policies, and will they continue to determine the winners and the losers? And I would chalk probably that the determination of winners and losers as an unintended consequence of public health issues or public health measures and government policies. The asset owners compared to the renters, that's something bears to watch. In order to have an economy that is healthy, you want everyone participating in the recovery or at least the growth. Canadian housing is dominated by 2 and 3 markets. Are we going to see a migration to secondary markets like we've seen in the U.S. in the chart that showed you for the U.S. markets on the rent side and on the Case-Shiller Housing Index? We saw that there was a migration out of the Midwest and in the New York area and the Northern California area towards other markets. Are we going to see the same thing in Canada, where we're going to see the high prices and the work from home, that combination? Is that going to equate to an exodus of the 416-905 regions, or the 514-450, which is Montreal, or 604, which is Vancouver? Remains to be seen, and that may have an impact on consumer spending going forward. Really, brands, distribution, and innovations continue to add value for companies. That really hasn't changed, and we will continue to look for that. The goal remains to own great assets and purchase them at reasonable prices. You want to limit the downside risk, by selling out or reducing some of the more expensive one, and we did go through that last quarter with trimming some of the positions that had run up. As always, we thank you so much for your trust in managing your investments, and are looking forward to hear from you, and certainly looking forward to the opportunity to meet and be chatting with you in person. Thank you so much for watching. I'm Benoit Poliquin for Exponent Investment Management.